In financial statement analysis, the notes were shared. And just key areas that we need some concentration on is if we're divided into number one, we have ratio analysis. We need to know how to do the profitability ratios. The profitability ratios, we have liquidity ratios. We have gearing ratios. We have activity stroke turnover stroke efficiency ratios. Activity turnover stroke efficiency ratios. And you also have stock market ratios. Stock market ratios. Other than ratios in that topic, we also have the second part of it, financial forecasting. For the financial forecasting, you can either use number one, cash budget, or you can use the percentage of sales method. So this topic does not affect wale watu wa ATD in your FM. And I think we are all doing FM, including Consolata, who is online. So the percentage of sales, the cash budget, the percentage of sales method. Then of course, number three, we have common size financial statements. Common size financial statements. In the interest of time, we may not be able to go through it in class, but I know when you check in the YouTube, there's some videos for that. Unfortunately, lazima tu tuziembrace because of the time that we have today. So the common size, we have the vertical, and we have horizontal. Probably mfanya kwa financial reporting and analysis. If you're lucky to be having that paper too, it's not different. It's not different, the horizontal and the vertical. But kama mjafanya, you embrace it in the YouTube. You'll get it there. Maybe for today in class, this one is a little bit complex. You can handle this one, the percentage of sales method. Then this is zingine kindly. Hata ukienda tu kwa YouTube search common size financial statements, watakuletea how to do the vertical and how to do the horizontal. And it's very easy. One of them, you get each item as a percentage of sales. And the other one, you get each item as a percentage of total assets. Iko hapo very direct. Have an idea of it. So that is the three parts of the financial statements analysis. So maybe let's handle this. Ilitestiwa kitambo, inakanga a little bit complex. So financial forecasting using percentage of sales method. Then you say, it assumes that number one, there is a direct there is a direct relationship. There is a direct relationship between sales and various balance sheet items. There is a direct relationship between sales and various balance sheet items. Into brackets, total assets and current liabilities. Total assets and current liabilities. Number 2, the existing relationship between sales and the balance sheet items. The existing relationship between sales and the balance sheet items shall be maintained in future. So that relationship shall be maintained in future. Another assumption. The firm is currently operating at full capacity. The firm is currently operating at full capacity. So hakuna spare capacity. Number 4, payout ratio is known in advance and with certainty. Payout ratio is known in advance and with certainty. In gross profit margin, sorry, net profit, not gross profit, sorry for that. Net profit margin is known in advance and with certainty. Net profit margin is known in advance and with certainty. You can skip one line and you say, under this method, a given increase in sales should be supported by an equivalent increase in total assets. So sales ziongezeke, lazima hiyo increase in sales ikuwe supported na assets. Like now, for us to increase sales, we must buy more stock. Stock is an asset. If you're a manufacturing firm, we must expand our manufacturing industry. So when we increase sales, the total assets must also increase. Full stop. To finance the increase in total assets, the firm utilizes the increase in current liabilities. And the expected retained earnings. And any other financing if needed. Shall be raised from external sources. And any other financing, if needed, shall be raised from external sources. Hence, and the formula for external financing equals increase in total assets. I'm going to explain it. Increase in total assets minus increase in current liabilities minus increase in current liabilities, then minus expected retained earnings. So increase in total assets minus increase in current liabilities minus expected retained earnings. So this is what you're saying. Sales zinaongezeka, lazima uongeze assets. Now, for us to finance the total assets increase, I'm just explaining it. If our total assets are expected to increase by 10 million, lazima tutafute penye tutatoa 10 million ili tuweze kununua hizo assets. So how do we finance the increase in total assets? We shall start by using the increase in current liabilities. Sometimes we go in for a stock and we buy it on credit. Creditors and liabilities. They are financing our assets. Maybe the current liabilities will increase by 3 million. Then we ask ourselves, how about the expected retained earnings? If the retained earnings are maybe 4 million, then that means to finance the 10 million, we shall get 3 million from the current liabilities and retained earnings shall give us 4 million. So meaning there's a deficit of how much? Of 3 million, which we have to go outside and borrow. So these are the internal funds. So this one, we have to go outside and borrow the external financing. Now, so in arriving at the 3 million, we take the increase in total assets minus increase in current liabilities minus what? The expected retained earnings. That's how. Great. It was tested last time, I think, was in 2016. 2016. So you can check it there. (2016). The 2016, November 2016, question 3A. Page 68. November 2016, question 3A. Page 68, right there. Great. So we are told that the management of Georgina Limited wishes to establish the amount of external financial needs for the year ending 31st December 2016. Since we are going to establish what we need next year, that is forecasting. 2016, the statement of financial position of the company as at 31st December 2015 was as follows. So in 2015, plant and machinery, furniture and fittings, motor vehicles, inventory, account receivables, and cash and bank. You can see all those are assets, both current and non-current. Financed by ordinary share capital, retained earnings, 14% debenture, payables, and accruals. The sales for the year ending 31st December 2015 amounted to 120 million. So the sales for 120 million was supported by the balance sheet of 2015. Sales for 2015, balance sheet of 2015. The company forecasts that sales will increase by 10% for the year 2016. For the year ended 2015, the after-tax profit of the company amounted to 18 million. The company adopts 80% payout ratio as its dividend policy. The payout ratio is expected to remain constant each year in perpetuity. The after-tax profit margin is also expected to remain constant each year. Assets are expected to vary directly with sales, while accounts payable and approved expenses form spontaneous sources of financing, no problem. Any external financing will be effected through long-term debt financing. And you're being asked the amount of external 12% long-term debt financing that will be required for the year ending 31st December 2016. Now, in answering that question, first of all, we go back to our basics. There is an existing relationship between sales and the total assets and between sales and the current liabilities. So first of all, let us get that relationship. So working yetu ya kwanza, we look at the balance sheet item. Balance sheet item and its percentage of sales. Balance sheet item and its percentage of sales. And remember, even as we look at the balance sheet items, tumesema total assets and current liabilities. So it's for assets. Assets ya kwanza, we have plant and machinery. So you have plant and machinery. Plant and machinery, 2015 against sales of 2015. So plant and machinery valued at 31. So 31,200. The sales that we have, the 2015. This one 20,000. So how much is plant and machinery as a percentage of sales? That 100 over 120,000. That's 100. 6%. Furniture and fittings. $18,720 divided by the sales of the same year. Note number 1. Yes, balance sheet for 2015, we compare the sales of 2015. So what is the percentage? (15.6%). Another concept that we have, motor vehicles. The value for motor vehicles is 12,480. So 12,480 divided by the sales of 120,000, it's 100. 10.4%. We have inventory. As a percentage of sales, inventory is valued at 19,200 divided by 120,000 times 100. How much? What percent is that? 16%. So 16%. For the receivables. Receivables are valued at 14,400 divided by the sales of 120,000. 2015 against 2015. 12%. We also have cash and bank. Valued at 3,600 divided by 220,000 times 100, 3%. So can we have our total assets? So add hizo percentage zote. Page 68. So 83%. Inamaanisha nini? That the relationship between total assets and sales is that the total assets are 83% of sales. Total assets are 83% of sales. So kama niko na sales na nataka assets zangu, I'll simply do 83% of the value of sales. That will give me my total assets. What are total assets as a percentage of sales? The total assets as a percentage of sales is what? 83. And there's an existing relationship between sales and the total assets. What is that relationship? That given the value of sales, I can get my total assets. There will be 83% of what? Of sales. That relationship has to be maintained even in the coming year. And for us to maintain that relationship, inamaanisha kuwa when sales increase by 1 shilling, our total assets should increase by 83% of the 1 shilling. Any increase in sales will lead to an equivalent increase in total assets, which is 83% of that increase in sales. Because of that relationship. So can we have current liabilities? For the current liabilities, we have payables. Payables as a percentage of sales, 18,000 divided by 120. %. Then finally, for the accrued expenses, which is 12,000 divided by 120. This is 10%. So current liabilities is 25%. Right? Then we ask ourselves, what is the increase in sales? Sales are expected to increase by what percent? 10%. So meaning our sales will increase by 10% of 100 and what? So sales increase by 10,000. Now let me explain myself again. The percentage of sales method inasema kuwa sales that increase by 12,000. For this existing relationship to be maintained, our total assets must increase by 83% of the 12,000 because of the relationship. Anytime I need the total assets, there will be 83% of our sales. Anytime I need my current liabilities, there will be 25% of the sales. That's how. From our formula, we don't want the total assets. We need what? The increase in our total assets. When sales increase by 25,000, our total assets must also increase by 83% of the increase in sales. So therefore, external financing is equals to increase in total assets minus increase in current liabilities minus the expected retained earnings. So fortunately, Shandika formula. So let me have those variables. The figures are in thousands of shillings. Can I have increase in total assets. Which will be 83% of what? Of 12,000. Ukifanya 120 plus 12, haitakuwa the increase, itakuwa the new. Because in 2016, if you want to get the total sales, will be 120 plus 12,000. But hapa kwa formula yetu, hatutaki the total assets, tunataka the increase. So increase in assets, we can only compare it with the increase in sales, not the total sales. Wakati tutataka the total assets, ndio tutafanya 120 plus 12. But just need that incremental, the increase part. So total assets will increase by how much? 99.60. Right? Then we less increase in what? In current liabilities. We less the increase in current liabilities. Current liabilities 25% of the 12,000. How much? So 3,000. Then you also need to less the expected retained earnings. The expected retained earnings. Now, retained earnings tunazipata kwa profit after tax. Tunazipata kwa profit after tax. Do you remember how to get net profit margin? Formula net profit margin equals to? Margin is the profit on sales, and cost of sales. Margin is the profit on the markup. So markup is the profit on cost of sales. Margin is the profit on sales. Jason 2 is it? Oh, I can. Markup is the profit on cost of sales. Profit on cost is known as the markup. Profit on sales is known as margin. So gross profit margin, gross profit over sales. Gross profit markup, gross profit over cost of sales. Sasa, napa nitaka net profit. Net profit is the profit after tax. So net profit margin is the profit after tax over the total sales. Why am I doing this? Because I know, kama nataka retained earnings, nikishapata the profit after tax, sinita less dividends. Nikisha less dividends na baki na nini? Retained earnings. So how will I get the profit after tax? Siko hapa. I simply make it the subject. So profit after tax equals what? Net profit margin times the total sales. And remember, I don't want the increase in retained earnings. I need the expected. Expected is the total now. Ndio sababu hapa nimetumia total sales. Get the difference? Yeah. So, unfortunately, examiner hakutupa hiyo markup margin, sorry. Lakini akatuambia for the year 2015 wako na profit after tax ya pesa ngapi? Note number 3. Is it 18 million? Tuko 2015, sindio? Na total sales of 2015, 120. So what is the margin? 18,000 over 120,000, 15%. Alafu akasema, note number 5, the after-tax profit margin is expected to remain constant each year. So meaning even the net profit margin for 2016 itakuwa 15%. Right? So, can I get the profit after tax? In 2016, it will be the net profit margin times what? Times the total sales. Right? Our net profit margin in 2016 ni ngapi? 15%. Total sales ni ngapi? 120,000 plus 12,000. Total sales now. Giving us 19,800. Now, out of 19,800, how much are we paying out? Note number 4. How much are we paying out as dividends? Is it 80% the payout? So how much will be the retained earnings? So therefore, expected retained earnings becomes 20% of 19,800. Ambayo ni ngapi? 3960. So can you have external financing? So the difference becomes 3,000. 3,000 still. Now amesema hiyo external financing itakuwa from the long term debt. Ndio amesema. Itakuwa long term debt. Too much work performance. But you see, the workings that we've done are also going to help us get the 6 marks. So let's see for the 6 marks. For the 6 marks, umesema a forecasted statement of financial position as at 31st December 2016. Now the statement of financial position, they don't in getting the balance sheet, they don't need the increase in assets, need the total assets for 2016. And for that reason, we need to get the total sales. Total sales for 2016, which is 120,000 plus what? Plus 12,000. This gives us 132,000. And remember the relationship. Plant and machinery need 26% of sales. So even come 2016, plant and machinery will be 26% of what? Of our sales. Because nikitakaza 2015, nikifanya 26% of sales, itapata 31,200. So what is the relationship between plant and machinery and sales? Plant and machinery is 26% of sales. Motor vehicles is 10.4% of sales. Sasa hii ni ile balance sheet ni lazima ibalance. Kama zile zingine zinakatanga, hii haifai kukatanga. So this one, wanataka the statement of financial position. So the forecast statement of financial position. for 2016. So no problem, the figures are in thousands of shillings. So unaanza na kwanza tupande juu, plant and machinery. Plant and machinery. What is the relationship? 26%. How much is our sales? 132,000. So how much will be the plant and machinery? 34,320. Here we plant and machinery, furniture and fittings. %15.6%. So 15.6% of 132,000. 592. Tuko na motor vehicles. Motor vehicles is 10.4%. So 10.4% of 132,000. 13,728. After motor vehicles, tuko na inventory. Inventory is at 16%. 16% of 132,000. 21, 120. After inventory, we have receivables. Receivables is 12%. So 12% of the new sales. 15,840. Then tuko na cash and bank. Cash and bank 3%. So 3% of our new sales. 49. 3960. Si assets tumemaliza. Then tunaenda kwa financed by. Financed by. Vile nimejipanga tu. Hapo kwa financed by, tuko na ordinary share capital. Hakuna mahali tumeambiwa kwa ordinary share capital itaguswa. So our ordinary share capital shall remain to be how much? 42,000. Right? Do we have retained earnings? Retained earnings tunakuanga na retained earnings for the year. Then we add retained earnings brought down. To get the retained earnings carried down. How much is the expected retained earnings? 3960. That is the retained earnings for the year. We have the retained earnings brought down from the previous year of 17,600. So how much will be the retained earnings carried down? So ile ulikuwa nayo kufunga last year plus ile utaongezea huu mwaka. 21,560. Right? We have 14% debentures. Hawajasema zitafanywa anything, there'll be no redemption. Debentures ni za ngapi? 10,000, ndio. Then can you also incorporate the long-term debt? Sije itakuwa. So you have the long-term debt. Ile external financing. Which is of how much? 3,000. Ukimaliza hizo, vile iko tu, we have payables, which is 15% of the new sales, giving us 19,800. Then finally, accrued expenses. Accrued expenses ambayo ni 10% of 132,000, that is 13,200. Find out if it balances. $109,560. Inafaa balance bila jasho. Pale tukata hii balance. Is the same? I was told that TFR kwa ina balance mwalimu akiwa class.